even if you don't have an FHA loan, but you have a conventional loan on a different house, you're buying another house, you can't get an FHA loan.
You can.
You can?
Yeah.
Okay, see, I didn't know that.
See,
I thought you couldn't.
And a lot of these rules have changed.
Okay.
So,
yes. So welcome to Let's Talk Real Estate. It's been a while. Dan. I think
it's been several months
since we've had you on, and I'm so happy to have you back. It's always a great conversation with you.
In person. This is different.
I know. Yeah. It's in person. It's on video.
Yeah.
It's changed.
I had to shave.
You had to shave. I had to do my hair and makeup. It's all. Yeah, it's all kind of crazy, but
right.
But here we are. So
looking forward to it.
So Dan Coffey, who, for all of you who don't know, who haven't listened to another episode, Dan Coffey's a mortgage banker with Ameris Bank, and he is my source of information, all things related to mortgages and to just the economy in general, because you're really good at that as well. And so, you have the pulse on all of that. And I love the newsletter you send out to realtors.
Thank you.
It's often Sunday morning coffee or Saturday morning coffee,
yes,
or one of those. So I read it whenever it comes in. It's probably one of the only newsletters that I really read from top to bottom because it's so educational. So
I'm just trying to make sure that the folks that I deal with have as up-to-date information as they can. And when I'm talking with people, I will often say, let me check to see if anything's happened in the last 10 minutes. Things are just constantly moving, positive and negative. I just want my clients, my realtor clients, to understand as much as they can.
Yeah. Well, I'm glad that you're doing that, because an educated realtor is a much better realtor.
Yes, ma'am.
And we then can educate our clients as well, which is very important, because even though you educate them, we need to educate them as well.
Yeah.
And to prevent issues like sometimes we have at closings. So
I think people who they want to, this is a great experience buying a house, and they want to enjoy it. Mm-hmm. And the more they understand about it, the more they're going to enjoy it. So I try to educate right up to that point that helps them positively without drowning them in the details that they get drugged in.
Right. But they need to know, to a certain extent, they need to know the details in order to be able to process the whole thing and understand what they're getting into, because oftentimes, it's not like a casual process to buy a house.
It's the biggest purchase, and we need to help quantify it for them as quickly as we can, and help them pre-qualify for it. Helping them understand the monthly payments, but also the cost to get in, so that they feel comfortable with that and can shop with confidence that they're pre-qualified and that they're going to have the assets necessary and all that. So the more education, the more we can prepare them, the more fun they're going to have buying.
Exactly. Yes. And the less stressful, for sure, at the end, getting there at the end and not knowing, things like closing costs and all those are always a surprise.
There is no excuse at all for people being surprised at the end.
Right.
As far as I'm concerned, it's our job to make sure that they know everything they can possibly know, especially the money.
Exactly. Yep. It's all about the money, really, at the end. So, So speaking of money.
Yep.
Money, the situation's been a little bit crazy just in America in general with interest rates. And
you're going to ask me where the rates are going, aren't you?
I'm not going to ask you where they're going necessarily, unless you want to share that, because you probably don't have a crystal ball and you can't tell me where they're going.
True story. Back in 1981, 4 other loan officers and I was up in the Northern Virginia area. We went to Spencer's Gifts and we bought a crystal ball. And we went over to Ocean City, Maryland, and we buried it, because we were so smart that we could outguess what was happening with interest rates. I think there was a case of beer involved, but
I would think.
I swore at that time I would never strongly predict. All I try to do is tell people what I see, and then allow them to make their own decisions.
Right. Yeah. So, okay. So interest rates, the Fed interest rates affect the mortgage rates.
Yep.
And so what are we seeing right now?
We have seen the interest rates rise as over the last year as the Federal Reserve has stopped, I'm going to use the word interfering, has stopped trying to lessen the pain as they have allowed the market to actually get to where it needs to be for many, many years. I think that the Fed has tried, the quantitative easing is sort of a watchword for what they call this, but they were trying to protect people from the pain of high rates.
Right.
And I've always looked at the economy as an organism that has its own rules, and a free enterprise is its own thing. And when you try to repeal natural law, when you don't allow the organism to go and flow, now that may be some pain for some folks.
Sure.
But if it's not allowed to, because you want to save people the pain, and you keep the interest rates down kind of artificially, and then you decide, as they did last fall, to allow the market to seek its own true level, that's when you see the rates finally rise to where they needed to be. So in terms of interest rates, I just looked yesterday on a 5% down, and I have to kind of quantify this.
Sure.
Interest rates for mortgages are a function of credit score and down payment.
Okay.
Someone with a 780 credit score yesterday, the rate was, and on a 5% down transaction, $275,000 loan. The interest rate was 6.5%.
Okay.
For that very same transaction, $275,000 loan, the borrower with a 720 score, the rate was 6 7/8.
Okay.
So there is a linkage that Fannie Mae, who buys these loans, has between credit score and down payment. So there's a risk that they're measuring here. So let's just think in terms of 6.5. There's the typical answer to where rates are going is they're either going to go up or down or stay the same. I think that the group who says they're going to stay the same would be the group who says that there's stability, and there's very few of those people who think that we're in a stable market. They think we have a group who honestly believes it could edge up toward 8.
Oh.
It's a small group.
Okay.
There's a larger group who believe, for all logical reasons, that we're actually going to head down next year into the high 5s, to mid 5s. So that's the two. There are some really smart folks on both sides of the ledger, but I think that the ones that make sense to me are the ones who are predicting that we've capped, and now we're really headed down.
Okay. Let's hope so.
And I could dig into some of the reasons why, but that's really my prediction would be that next year we're going to be in the 5s.
Okay. All right.
Just slowly get there. We only predict one more Fed move this year. And the Chairman Powell has been table pounding for the last 3 or 4 of his meetings that he gives after the Fed meetings. He gives a little interview, and it's almost the guy you could... It's like the Dark Knight. I mean, the guy was table pounding. We're going to stamp out inflation. We're going to get to 2%. And it really sounded very militant. Well, after the last one that just happened last week, completely different tone.
Yeah.
It was more conciliatory. It was more like, we think we're probably going to get to 4.5% inflation by the end of the year. And this is sort of it was reasonable. It was a reasonable approach. And I think that that's also supportive of lower rates as we go through the year. It's not going to happen tomorrow, but over a little bit of time, I think we're going to trail down. But that's me.
Now, do you think Chairman Powell was being the way he was being because of Silicon Valley Bank and all that?
That was a surprise. It's funny because we saw our rates drop 0.25% on a day. And the whole thing had to do with what we call flight to safety. The investors who might be putting their money in the stock market all of a sudden threw their money into bonds, which is where mortgages are. And we were flush with cash, and the markets dropped and whatnot, thinking, oh my gosh, do we have a terrible banking issue here? I think we had a couple of outliers that were doing some things they probably shouldn't have been doing. But I don't see it. Our banking system's safe and sound. They actually increased the Fed rate by 0.25% in the face of this.
Yeah.
So there were a lot of people saying, oh, they're not going to increase the rate because they're so concerned about what this might do to people's perception of banks. I think it strengthened people's perceptions of the banking industry by continuing along their path without making a special exception for, honestly, what I just believe are a couple of banks that are just outliers.
Yeah.
They weren't indicative of a problem in the system.
All right. Well, good. I'm glad it's not a problem.
I
you
wonder
know.
what I just said. I'm always wondering what I'm going to say to you. Right? What's going to come out of his mouth?
Well, we go on tangents, you
That's
know.
it.
It just kind of snowballs.
Sort of organic.
It
you know?
is organic.
All
It's an
right.
organic conversation.
Right.
I have like these 3 questions prepared, and then it
Away
turns
we
into
go.
20 questions, and
Yeah,
you
that's
know.
it.
Yeah,
That's-
but
that's life.
That's okay. That's why these conversations are interesting and informative.
That's why I have to look at the playback.
Exactly. Well, okay.
So I can feel whether I've informed in it.
No problem.
Right.
That's we'll do that for sure. So yeah. So tell me a little bit about right now the FHA loans have changed a little bit.
They have. FHA is the granddaddy of all loans. It's the 1934. Fantastic. It was the original 30-year fixed rate mortgage. They didn't have 30-year fixed rate mortgages before that. Prior to that, you had to put 30% down. You might get an arm that adjusts every 6 months. You'd pay interest only. I hope the bank was there when you went back 6 months later. This is back in the O's in the 1910s and up to the 20s.
Okay.
And they really had some real problems. So they created FHA because it allowed 3% down payment. Mm-hmm. And this is soapbox. It helped create a middle class.
Yeah.
People being able to own their home was the foundation of a middle class in the country. We had a merchant class, and we had a rich class and a poor class, but a middle class, really, housing was what it was all about. So it was a stroke of genius. So what FDR did in that program, he created FHA, 3% down, and the lenders who would not lend with 3% down, well, now we're going to have a federal mortgage insurance. Mm-hmm. This mortgage insurance would pay you, Mr. Lender, if you had a loss by doing this loan based on our rules, in terms of ratios and what kind of documents we want you to get. But if you incur a loss, we're going to reimburse you through this insurance fund. So it was the original mortgage insurance. So they have been, they've changed over the years. I've been in the business since '74, and I've probably seen 5 different adjustments to how they do their mortgage insurance. Mm-hmm. Most recently, they were charging 0.85% per year for mortgage insurance. Now, how do we equate that? That's $850 a year on a $100,000 loan.
Okay.
Divided by 12. And so on a $200,000 loan, $1,700 divided by 12. And that mortgage insurance, as the regulations currently sit, is for the life of the loan. Will never drop off. Now, that's if you put the 3.5%, which is the minimum down payment these days. If you put 10% down, it'll fall away at 11 years. But we're going to talk about the minimum down version. Mm-hmm. So it'll be there for the life of the loan. And at 0.85%, it was not as competitive compared to private mortgage insurance. Private PMI created in 1954. So they watched FHA do insured mortgages for 20 years and then said, hey, why don't we do this on conventional loans? So a private mortgage insurance industry got created. So we have PMI. And when we're talking with people about putting minimum down, 3% for a first-time buyer for conventional, 3.5%, you don't have to be a first-time buyer, but 3.5% for FHA.
Right.
Those are where our minimum down payments are. But when I was comparing private mortgage insurance, FHA, this 0.85 was really, it had really caused a quite a bit of a reduction in the number of FHA loans.
Okay.
People were looking at this 0.85 as, forever and ever? Can't get rid of it? This is too high.
Right.
And we actually saw over a 2 or 3 year period of time the pendulum swing to more 3% down conventional than FHA. Well, 3 weeks ago, they changed this to 0.55%. So now they've lowered it by 30 basis points. I got some. It used to, on a $275,000 loan, it used to be $194. Now it's $126. So it's a $70 drop per month. Huge.
That's huge.
It really is. And I've already done 3 of those, and I feel much more comfortable. FHA has a lot of other positives to it. It's more liberal when it comes to the qualifying ratios. And interestingly, I was talking earlier about the interest rates on that 720 score, 275,000 loan. Conventional was 6 7/8.
Right. Yeah.
FHA is 6 1/8.
See, that's amazing. So you're saving on mortgage insurance
And 0.75%. So
yeah.
if you just add the 0.55 to the 6 1/8, you're not even up to where the base rate is on the conventional.
That's
So it's really become, and FHA loans, I'm talking too fast. Fannie Mae is the purchaser of conventional loans. And they're insured by a private company. FHA loans are insured by the full faith and credit of the U.S. government. FHA loans, VA loans, and USDA loans are government insured or guaranteed. They get bundled and they sold into a Ginnie Mae security, not a Fannie Mae security. And those, because they're so protected by the government, 0.75% difference in the interest rate. So we are really seeing FHA jump back into mainstream because of that.
That's great.
Yep.
I mean, that's really, really great. Now, FHA isn't for everybody.
Nope. Well,
So-
there is a limit. $472,000 is the maximum loan that we will do in this market, which honestly covers a lot of homes.
It does.
But it is not for everybody. True.
Yeah. Yeah. So who could not get an FHA loan?
If you already have an existing FHA loan,
Okay.
you can only have one at a time.
Right.
FHA is the nation's lender, so they are more broadly available than anybody. There are fewer restrictions on FHA than on conventional. Do you have it in mind, any particular?
Well, for example, even if you don't have an FHA loan, but you have a conventional loan on a different house, you're buying another house, you can't get an FHA loan.
You can.
You can?
Yeah.
Okay, see, I didn't know that.
See,
I thought you couldn't.
And a lot of these rules have changed.
Okay.
So the FHA, you could own 5 investment properties
Okay,
and get an FHA's owner occupancy.
exactly.
All right. So, but if you had 5 investment properties and you want to get an FHA loan, it's okay.
Okay,
But if you get an FHA loan and you live in the house because you're required to, you can't then go down the street and get another FHA. They only allow you to have, there's a couple of exceptions. If you get transferred over 100 miles away, if your family size doubles, I mean, there's sometimes they'll allow you to have 2 FHAs in the same market. But other than that, FHA is not restricted to first-time buyer. It's completely wide open.
yeah. It's wonderful. It's a
It
wonderful.
is.
How about credit score?
Credit score for the minimum credit score for conventional says 620. And conventional will now allow you to average 2 scores. If one is 650 and the other one's 610, they'll allow you to average it so that the average is above 620. They're going to have you price it based on 610. Very, very high
Interesting.
pricing. FHA states 580.
Oh, wow.
But there's a lot of caveats that go with that. There's going to be a review in underwriting. To a 580 score, there's something going on.
Right.
They will actually consider a 520 with a lot of money down. But again, there's a lot going on.
Sure.
Lenders are not going to make a bad credit loan. But if they can determine that the reasons behind the score are those that are not pointing at a borrower who doesn't want to make their payments, some other thing.
Yeah.
So but 580 is really the number. And I honestly, once we get into the 580s, we're looking at some credit that's going to have a lot of explanation, and it still may not make it. Honestly, when we get into those credit score levels, 9 times out of 10, the Fannie Mae decisioning software that we use, instead of giving us an approve eligible, will give us a refer.
Okay.
And a refer means it has to go to a flesh and blood underwriter. It's not going to be decisioned initially by the Fannie Mae software.
Gotcha. Okay.
And once it gets to a manual underwrite, whole new book of rules, much more stringent, lower qualifying ratios allowed, much more stringent guidelines. So Technically, the answer to your question is 580. Once we get below the 620, there are often challenges that have an impact on the file that we really can't predict. And obviously, I want to be able to provide you as a realtor with a pre-qualification letter, and I'm not going to do that unless I can stand behind it.
Right.
So until I can clear all the contingent liability that might be involved with a particular credit score, I'm going to take some time before I give the people a pre-qual. So
yes. So nowadays, the market is shifting slightly in favor of buyers.
yes, ma'am.
Slightly, though. I don't see it in every
No,
case.
but now it's like I've stopped seeing 10 other contracts on the property and started seeing 2 or 3.
Right.
And honestly, that is an incredible improvement. It's helping the buyers out a lot, less competition.
Right. And then a lot of sellers are offering some incentives.
Yes, ma'am.
And
They were very wise.
yes. And so one of them is to buy down mortgage points.
Correct.
A lot of people have no idea what that means.
Okay. I like the whole idea of seller concessions. When I think of sellers who will only accept cash, then there's this little pyramid of people that will they'll buy their house, and if you bring it down one level, conventional financing, and if you bring it down another, you just keep broadening it.
Yeah.
VA and FHA entertain those as a seller, and then the broadest is the bottom, where the seller would consider providing a concession to the buyer. A seller concession is completely legal. The amount that a seller may provide in a concession varies based upon how much down payment. On a conventional loan, with 5% down, the seller can give $3%.
Okay.
So on a $300,000 purchase, the seller could contribute $9,000 toward the buyer's settlement charges. I don't know that they'd be that high, but again, they can't exceed what they are.
Sure.
But, that's a goodly amount. Now, with 10% down, it can be 6%. I don't know what they'd be paying because the closing costs aren't that high. Right. FHA standard 6% is allowed for the seller to pay. Now, how that is applied, one of the most interesting ones is the buy down. Yeah. What we call it a whole loan buy down. And if you conceptualize, you are the investor on a mortgage. The investor has millions of dollars to lend, and they have somebody who works for them who tells them, today you should be able to get 6.5. The investor says, okay. His finance guy says 6.5. So we create a mortgage, and the mortgage is good credit, and it is investment quality, and that's what they're looking for. So we call up the investor and we say, we have a 6.5% note and mortgage, and it's for $100,000, and the investor says sold. So we give them the note, and they give us $100,000.
Okay.
But then we call them up the next day and we say, you know what? We have another perfect mortgage, but the person doesn't want to pay 6.5%. They want to pay 6%. So the investor asks his finance guy, what is the rate today? And he said, you should be able to get 6.5. So he gets on the phone and he says, well, I should be able to get 6.5, but that is a good investment. So I will allow you to have a 6% rate, but I need something else in cash so that it will be equivalent in yield to 6.5. So you can give me the 6% interest rate note and money. So when money is paid to lower the rate, we're buying down the rate. That's all we're doing, is paying money to the investor up front, and the investor is going to receive an equivalent yield when they look at the rate on the note and the money that they're receiving. So all a buy down is giving the investor the same yield in a different format. So we can buy it down, and I wish that I could tell you that there was a straight line, and if you pay this percent of the loan amount, it'll go down an 1/8%. If you can pay this percent, trying to find a linear way to, but I think in terms of 0.5% of the, I need to define points.
Yes, define points, because define
we
everything.
We talk in terms of points. It's a unit of measure. 1 point is 1% of the loan amount.
Okay.
My $275,000 loan, 1 point is $2,750.
Right.
Okay. What's weird is that if we're going to charge any amount, we say, if we're going to charge $500, we say $500 in points. Well, a point is 1% of the loan amount. So it's a unit of measure. It's a term we use to describe money that's paid to lower the rate. So points are the label we give. In my early example where the guy got the 6% rate and they had to pay money, the money he paid was points. So that's, we're buying it down by paying points. Okay. All right, where was I going? So currently, if I had the $275,000 loan, it would take 1 point to buy it down 0.5%.
Okay.
Now this, I wish I could say was law, but every single day we look at a rate sheet, and every single day each 1/8 of a percent is a different price, and it's not exactly linear. It's kind of close, but for the sake of having a thumbnail gauge, think of every 1 point you pay will lower the rate 0.5%.
Okay.
So if we were to lower the rate on our 275 loan from 6.5 to 6, it's going to cost us $2,750.
Okay.
The seller could pay it. Yay. The buyer could pay it.
Yeah.
And what it's going to do is reduce the payment by $90.
Okay.
Now that doesn't seem like a lot. So the way we look at it is, well, okay, if I'm paying $2,750 at closing, and I'm saving $90 a month, well, how long is it going to take for me to recoup the money I just paid? 30 months.
Okay. So
2.5 years.
Yeah.
So from every day that every month those people live in that property, beyond 2.5 years, it's gravy.
Okay.
Whether they pay it, it's really gravy if the seller pays it.
Yeah.
I mean,
it's
talk
fantastic.
about a concession. That's a lifelong concession. If they stay for 30 years, no telling what the savings on 0.5% on a 275 loan would be. It's in the tens of thousands of dollars. So it is and what's the neat thing is that a lot of thoughtful sellers, I was talking about broadening the pyramid.
Yeah.
If you're wanting to make your home stand out on a competitive nature, because there's lots of houses on the market. If you want makers to stand out, if you're willing to offer this type of thing, just say, this is how much of a concession I'm willing to provide. And then the realtor and the buyer can decide how to use it. Well, if I can use this for my buy down, yay. Maybe I'll use it to offset closing costs. But the buy down itself I think, just has lifelong. As long as those people live in that property, they are going to receive the benefit of that lower rate. And I just think that's really cool.
That's fantastic.
Yeah.
Okay. Well, that's good to know because, I mean, I've read about it and everything. I've read about it in your newsletter, in fact, and I've explained it to people, but it's good to have it explained by you to our audience.
I hope that made sense.
It made sense.
Okay, good.
Yeah. So 1 point equals 0.5%.
That is the rule of thumb that I'm using
Yeah.
right now, yes.
Yeah.
What you do is call the lender on any given day and ask precisely what it is. But that really is close.
Do you have to lock that in?
Yes. I
Yeah.
mean, the borrower has to select a rate at some point in time in the process. We ask them up front because you're always talking interest rate. So most people will choose to lock right at the outset for 30 or 45 or 60 days. There's a different price. But they are perfectly free to float. I have a couple right now who really feel that the market's going to go down in the next 30 days.
Oh.
So we're processing the loan because they're required to apply within 5 days per your contract. So their loan's in process and the appraisal's already in. And they're about 10 days before closing. That's when we need to do our final lock process. And so far it's working out for them.
Okay.
So,
well,
I mean,
good for them.
And my secondary market department loves it when somebody decides to float because if they're providing a bet on rates, that's what secondary market departments do. If I'm giving you a 30-day quote, anything can happen in 30 days, and it might be a lousy quote down the road. So they're happy when a borrower decides to float their lock until later.
But if you do that, then you don't know what to ask the seller for if you want them
in that case, you just say this to Mr. Seller, how much?
Yeah.
And that's, I think, smart. the seller wants to know, even in terms of couching the phraseology of the contract, because at one point, if you on a 5% down loan is different than a 10% down loan. So I always think it's positive if the seller quantifies the amount that they're willing to provide in a cash concession.
Okay. Yeah.
And then allow the borrower to apply that however they wish to apply it. But you're right, we won't know precisely how to apply that to the buy down until the date that they lock.
Okay.
But
all right.
roughly equivalent, 1 point for 0.5%.
Okay. All right. Perfect. And most people do lock up front anyway.
Yes, I strongly advise it. There's so many other things going on. Lock and don't look back. That's what I do.
And so here we go. I know what lock means. What does lock mean?
That means that when we're committing to you, Mr. Buyer, or Mrs. Buyer,
yes,
we're committing to you to provide this interest rate at this loan fee, whether it's a zero loan fee or whatever. We are committed to provide you with that for a closing that occurs within the next X day, 30 days or 45. And that means that if someone selects locking, if the rates actually fall, we will not lower the rate.
Right.
If the rates go up, we will not increase the rate.
Exactly.
It is a commitment that we're making that we will deliver that product.
And you say we can lock 30, 45, or even 60 days.
Yes, ma'am.
Now, what changes there? Like, is
the pricing on a mortgage? I was saying earlier that a 780 score and a 720 score got different results in interest rate.
right?
That's because they were risk. There's also a risk to time.
Mm-hmm.
If a lender is going to guarantee a rate for 30 days or 45, there's greater risk
Sure.
in 45 days, and there's greater risk than that in 60. So there are slight increases in cost
Okay.
for the longer you lock.
Okay.
Just because it's interest rate risk.
I figured. Yeah.
There are extended locks, we call extended 90, 120. There are extended locks available, but we price them in a way that they're more expensive than the 60s.
Sure.
And typically we require somebody to put some money up front.
Okay.
Now this is a deposit that they only lose if they don't close with us,
Okay.
but we apply it. It's not an additional cost. It's sort of a security deposit on our part. Because when a lender locks a loan, there's a lot of things going on in the background. They actually hedge that risk. They actually purchase a commodity that hedges the loss they might incur if this was it works inversely to the value of the mortgage. It's really weird. We're not in the business of trying to make money on interest rates. All we do is close loans and collect monthly payments from people. But this whole interest rate risk is severe. So when I'm dragging you through the weeds here, but if you're in the market, in the secondary, if you're in the pricing department of a mortgage company and you're offering an interest rate that you're guaranteeing for 90 days, you actually purchase a commodity over here so that if this loses value, this gains value.
Okay.
And they're trying to find the perfect hedge product, but it costs money to buy that.
Right.
So when somebody says, lock me, bingo. I just go in and hit the computer and lock. In the background, we're guaranteeing the availability of that money by actually pledging some bucks here. It's not a no-cost type of operation. It's all built into every marketing department around. Does that make any sense, what I just...
Yeah, it makes sense. And so if you have to put some money down, a good faith deposit almost.
And it's applicable. It's
right.
only if you walk, actually, is we're trying to make up the money on the hedge cost we just lost.
Sure.
But we're happy as a clam to lock it out for... Oh, golly, I've seen... on new construction, I mean, we're talking 180 a year.
Yeah.
Those kinds of things. And in those cases, well, we're getting far afield, but on those cases, we'll cap how much it can go in the next year.
Oh, wow.
And then when it gets within 60 days of closing a year from now, it's either the capped rate or lower, wherever it happens to be. We're trying to do everything we can to address this question mark of rate, which flows down into payment, which flows down to worry on the part of the borrower. We're trying to do everything we can to address those numbers early in the process. But you're right, a lot of folks are looking at the 90 days right now. And we fully can handle that. It's just an extended lock rather than a normal, me hit the button.
Sure. And what I'd like to know is if you're going to put some money down because it's so extended, is that a percentage of what you think you're going to buy?
I think it's half a point, and I'd really have to get back to you on it. But I think it's the equivalent of 0.5% of the loan amount.
Okay.
So $100,000 loan, $500.
Okay.
But again, we don't keep that. It is applied at the
Of course.
end. It's given back. It's just sort of secures the money.
Yeah. No, and you have to do that, and it makes sense.
That's the way we do it.
Yeah, for sure. So, okay. Very neat. Good to know, because I'm working right now in situations like that, and I actually have the seller, but I want to know if the buyer can do that, and we can close a little later.
I always stay in my lane. There are times when we've had folks do the closing early and the seller staying in the house.
Yes, but they don't want to do that in this case.
And that's why I stay in my lane.
Right.
But I have seen, because we actually, on our conventional product, we will allow someone to close 90 days before their job starts. If it's a job, the typical job of the UF, where we have a contract, a bona fide contract that is going to start, and it's signed and sealed and delivered, we'll actually close a loan 90 days before, which is where we get into this. The people who are coming in want their level of comfort that they know where we're going. They're in their house before they start work. I mean, whatever. And sometimes that's when we run into the seller.
Yeah.
Continued occupancy agreement. But
yeah.
Again, you're
yes. Yeah. Seller post-close occupancy agreement is it can be a great thing, but
it can be a challenge.
Right. It can be a challenge. Yeah. So it's
I get it.
Yeah, I do. I get it as well. So, I think it depends on the seller and how much you trust the seller. And I always say, how well kept is the house?
That's it. When are we going to do our walkthrough? Before you leave? I mean, at closing, or
Exactly.
I didn't know you were taking that mantelpiece.
It's
best to keep it clean.
Yes.
It's. There are.
Yeah.
At least we can occasionally deal with the situation that requires some unique treatment. So.
Yeah. And to lock in for an extended amount, can that be any kind of loan, conventional VA, FHA, or is it just one type of loan?
What a great question. I know for all of our conventionals, I'm going to say all of them.
Okay. All right.
Because we hedge them virtually the same. If that's different, I'll get back to you.
Okay.
But it's all of our products.
Okay, good to know. I'm working with a VA loan right now.
Love VA. I've used mine 4 times. It's the best product on the planet.
It's wonderful. A lot of people are really afraid of VA loans.
And I don't understand.
I don't either. They're guaranteed.
Yeah.
So
this is truly. I don't understand why there's any hesitancy on the part of sellers.
Right.
To accept them. There's the appraisal is standard. Yeah. It's the same. Often there's only 4 fee appraisers that do VA, but they're done with the same standard as a normal conventional loan. There's no secret about it.
Exactly, and somebody who's applying for a VA loan is guaranteed to get the loan, pretty much. I mean, unless something crazy happens.
Yes. They VA wants to assist veterans, so we see them. Almost all the rules are pro-vet, and I've seen some that are unusually supportive of the veteran during the process. It's almost they have the veterans back, and everybody knows it.
Yeah.
But it's an excellent product.
It
and
is.
Very simple.
And it's changed a little bit recently in terms of
They lowered the VA funding fee a smidge. Back in 1983, Reagan started charging an administration fee to basically have the agency pay for what it was doing, and it was equal to 0.5% of the loan amount that they would charge the vet, and they actually added it to the loan. $100,000, $500 rather than $100,000, so you could finance it. That has now risen up to 2.3%, but that's down from where it was a few. But again, it's financed.
Right.
It's just a VA. It's a fee to pay for the Veterans Administration processing of the loan. But even with that, it's still the rates are 3/4% lower than conventional. And the qualifying is fantastic.
Yeah.
Veterans are well taken care of with that product.
Yes. Yeah. No, I'm not afraid of them.
I just don't understand why some sell. And I honestly believe it comes down to how familiar the professional is who's working with the seller.
Right.
There is no need to have any apprehension. There's no special fees. I've heard all sorts of things that sellers have to pay some special fees on a VA loan.
Yeah.
No.
Yeah.
These wives' tales, old wives' tales,
Yeah.
get started, and I honestly don't know how to stamp them out. So.
Yeah. No. Well, I mean, education.
Yes, ma'am.
It's
Over
the only
and over.
way. It's the only way. Maybe something else for your newsletter now.
I'll hit that.
Hit VA loans, because things are picking up in the market right now.
Yes.
And so, when you have several offers on a house and you want to know which loan would be the best one to accept if you've got multiple offers with the exact same price or, higher price or whatever, then, which one would be the best option. It doesn't mean that VA would be the last resort on a list like that.
Correct. And the impact there is no impact on the seller.
Right.
There's no special fee they're going to have to pay. There's no there's no costs that the seller is going to incur, whether it's a 100% loan or an 80% of value conventional loan. Everything is going to be the same. And often that VA buyer is much better qualified than a lot of the alternatives folks. But
Sure. Yeah. Yeah, for sure. You just need a roof that's not old. That's all. That's the biggest deal.
I have had more challenges with roofs.
Yeah.
In helping people qualify to some extent. The roof, as you know, my wife is a property insurance underwriter, so I hear this on a daily basis.
Right.
But we are, as soon as that roof gets 15 years or so, we are really finding a much smaller group of potential carriers. We've lost so many.
Oh, yeah.
And then just the prices are going up. Now, I think, there was a special legislative session this past December that addressed a lot of the issues, and hopefully we're going to see that. We're seeing a lot of folks use Citizens, which is kind of interesting. Citizens was always the insurer of last resort and always much more expensive. I mean, if you were going to build the wacky thing and you needed to insure it, you could go to Citizens. But as the rest of the natural law, the rates and premiums have risen for the private industry, Citizens didn't raise theirs as fast. So they're still down there at the bottom. And boy, oh boy, are we seeing a huge percentage of the new insurance policies going to Citizens just based on price. I think within a year and a half, we're going to see Citizens reach a critical point where they're not going to think that the government should be in the home insurance business. I'm glad that they're sort of there as a backstop, but now they've become mainstream.
Yeah.
And anytime a government gets into mainstream private enterprise, it's like, the government's here to help you, please. Don't. Those are the last words you want to hear. Yeah. You know what's interesting? I've had 3 clients right now that a year ago I was working with them and they decided not to buy.
Interesting. And now they're probably kicking themselves for not buying.
And yes, the rate,
Yeah.
but the prices.
Right.
Everybody
They've continued
always
to go up.
thinks that if I hold off until I save 10%, if I hold off until I save another 20%, the only better time to buy than today is yesterday.
Yeah, I
There
like
is
that.
no better time. But all of these people, they've all done the mea culpas, and all three of them are buying.
Yeah.
And even though it's a higher rate, they know they're not going to lose money. And if the rates go down, they can refinance.
Exactly.
And refinancing is not hard. It costs a little bit of money. There are some duplication of cost. You have to pay us again. But you can use the same survey and go back to the same.
Yeah.
If you use the same lender, you can go back to the same title company and get a substitution rate, which is much, much lower than normal title insurance. There are ways you can save some money, but if the rate drops 1%, and typically 1%, 1.25%, it'll pay off within 3.5 years.
Oh, wow.
The additional cost. So which is honestly the corollary to the buy down. If you're paying your own money,
Yeah.
you're paying your $2,750 to buy it down 0.5%, and a year from now the rates go down to 5.5%. Did you waste your money? So that is the conversation I'm having with people right now. There is a reason. The market in mortgage banking parlance has topped. You've heard of doing premium pricing, where we will, the normal rate is 6.5. Well, how about a 6 3/4? Well, wait a minute. If 6.5 is 0 points, what happens at 6 3/4? We give you money.
Oh.
So it's premium priced. You can actually do a higher rate loan and flow that money down to the borrower's closing costs.
Okay.
And we've done that 3 or 4 times. The key is we're now in a market where the pricing hardly has anything above. And the reason is that the market, whoever the market is, doesn't think there is an above. They think, wait a minute, if we do this loan, all I can do is refinance in a couple of years. In other words, we've reached a point where the market is telegraphing to us in their pricing that they're concerned that of the value of these mortgages isn't that great because they'll be refinanced in a couple of years, which is telegraphing they think the rates are going to be going low enough to refi, which brings us back to, if you can buy it down and you're saving $90 a month and you recoup your savings in 30 months, do you do that with the full understanding that the rates might go to 5.5 next year? So it's interesting discussion. It becomes, that's why if the seller's paying.
Exactly. That's what I was going to say. If the seller's
Yay.
paying, then yeah, exactly.
So
Wonderful.
it's a fascinating job. But I wish after all these years, I just can't predict anything. Like most people in my industry, I just react to what's happening and try to. The best thing that's happening here is somebody's buying a house, and they will never regret it.
Yeah.
That is going to be the linchpin for their net worth for the rest of their life. That'll be that core element, and can't beat that, especially when you see young folks making their first. I think the challenge that we're having here is that buyers now who are 30, for the last 10 years, from the time they were 20, if they had any vision of mortgages or buying, their frame of reference was 4%, 4.5% maybe. That was their frame of reference. They heard about these 2s and 3s.
Yeah.
But now they're looking at the 6, and it's taking a little bit of a psychological adjustment because their whole frame of reference is that prior 10 years when the government was artificially
Exactly.
keeping our rates low.
Yeah.
And now we're much more up to the natural law where we're watching things
Exactly.
go. So they're overcoming the psychological piece, but they're making the right decision.
Yeah. Yeah.
Dang sure.
Oh, for sure. I mean, home prices continue to rise. So whatever you're buying today is most likely going to appreciate unless we get some crazy thing like what happened, in 2000.
Even then, I have,
you know.
even then, when I look at 5-year projections, and I've gone back, I have me, I like just to analyze things. So I went back all the way to the 70s and tracked 5 years out rate, house price and appreciation rates and whatnot. Except for that one unique period, the 2008 through 2013, 14 time frame, you never lose money.
Yeah.
Regardless of what the appreciation rate was on that particular day. When you look at the 5-year projections,
Exactly.
you never are upside down. That particular 2008, 2013 thing, that'll never happen again.
Yeah. Yeah. Well, I hope not. At least not in our lifetimes.
No, the mechanics, the fundamentals can't be repeated. Technically, structurally, they can't be repeated.
Okay.
We can no longer, the kind of loans that were being done that created that mess are no longer even legal.
Exactly. Yeah. Yeah.
It's
Yeah.
gone.
So a lot of people were just saying, "Oh, it's going to be just like the crash, just like the crash," and I'm like, "No, it's really not."
No, I think
Things are
we've seen
different.
it. Well, and predictions are fine. Everybody has the right to have one. Some of these doom and gloomers are nuts.
Yeah.
In fact, there was, I won't say who, but a major network that is known for business. This person who's in charge of their housing sector, I have quotes going back 7 years. Every single solitary quote was all this negative stuff. And we tracked it against a particular property value. And it was almost as if every time whatever she said, just kept pumping and bumping.
Right.
So anybody who began listening to this person, if you had to make a choice, well, am I going to buy this house or not? Well, that person says I shouldn't right now. Well, the person who did, now we're watching how the thing is worth $150,000 more over that period of time.
Right.
Rather than listening to the experts. So some people, I think, pain sells, bad stuff sells, and doom and gloom is good for ratings. We are seeing a pause, maybe.
Yeah.
But that's it.
Slight.
We're not seeing any huge drop.
No.
And if there are, although what's funny is they'll find some isolated neighborhood in some isolated town that you can't even find in a Rand McNally map. But then they'll write the story about that particular
Of course.
neighborhood, the doom and gloom. Now,
No.
this, and Gainesville especially,
Right.
this is it's almost as there's a wall around us. We have our own demand that just keeps growing.
It's huge.
And we have, if not a shrinking supply, we don't have really a growing supply.
No.
Which is why we're seeing rents go up. You can either pay your mortgage or you can pay their mortgage.
Exactly.
And pay your mortgage.
Right.
Because, they're happy as a clam that you're paying their mortgage. But for crying out loud, grab a hold of that tiger and hold on to its ears and ride it. Because it's the only game in town.
Yeah.
The more people delay, I want to save $3,000 more. Oh, really? How long is it going to take you? Well, it might take me 6 months. Okay, do you want to see what the house price is going to be 6 months from now?
Exactly.
It's not going to matter a difference. What you need to do at this at this moment in time, talk to a mortgage loan officer, any mortgage loan officer, and find out what you can be pre-qualified for. Find out. I talk to people all the day long. I'm not ready to buy until next summer, not till next fall, not till next year. What do I need to know? Hey, let's talk about it. Because you can be prepared. I mean, all the things, there are, people can, it's like they feel there's a lot of hurdles to buying. They have no idea how many non-hurdles those are. If you just have a good, wide open conversation with a good realtor and a good loan officer and share.
Yeah.
Well, gee, I was really kind of concerned because I was going to get some money from my dad. Yay. Yippee. I got money from my dad in 1974 when I bought a house. Gift letters have been around forever.
Exactly.
And you may be thinking that's against some rule. There's a lot of, it's like reticular attraction. You buy a red car and all you see is red cars.
Right.
In real estate, there's always people talking about real estate. You're standing in McDonald's or wherever you are and somebody's talking about real estate.
Oh, yeah.
But there's always an expert there who, if you want to get the straight skinny, talk to a professional realtor and talk to a loan officer.
Yes.
Because the person who's standing next to you at McDonald's
has no idea.
is not the expert.
No.
And sometimes it takes a plan. Sometimes it takes a plan. Sometimes I could get off into all sorts of little tangents, little things. When I'm talking to somebody, well, how much money do you have in the bank? I actually have $12,000. I think that's wonderful. And if you're doing an online application, you type in 12. The next question is, have there been any large deposits in the last 2 months? Oh, yeah, I put $10,000 in last week.
Okay.
Well, the online application doesn't ask that, but all of a sudden the next question is, where'd the $10,000 come from? It was in my drawer. I've been saving it as cash. Now especially in Florida, if a hurricane comes along, there's a lot of people who have cash on hand. They want to have the cash.
I like this. It's like a lot of cash.
Yes.
People have cash
At
on
any rate,
hand.
so I had to say, I'm afraid cash on hand isn't acceptable. And then the next explanation is, when we do a mortgage, we collect the last 2 months' bank statements.
Right. And
We collect the last 2 months' bank statements. So let's talk about all the other things, and then we'll talk about 3 months from now, because the last 2 months' bank statements is what we're going to be looking at. We have no idea what happened in those bank statements before that. So if you want to season your money, which is your money, and we should be able to count it, but the doggone rules say we can't, put it in the bank. 2 months from now, we'll have 2 months' bank statements, and there won't be any large $10,000 infusion of cash that we can't explain.
Exactly.
And everything is completely above board and it's completely legal.
yeah.
And I'm very sorry that the cash on hand can't count. It's just one of those. It's one of those things. But that's one of those surprises that if you have a conversation and have a really full conversation with a good loan officer, then you can set yourself up so that it just rolls downhill when you want to buy your house.
Exactly. Yeah. Well, and that's why a realtor can point you to somebody who they know, like, and trust.
And realtors have seen the other side of this, where the commitment letter doesn't really stand up, and know the kind of ramification that there are when everybody is all stretched out, and then all of a sudden the pre-qualification letter isn't worth the paper it was printed on. It just wasn't done right. So yeah, the realtor is, to me, the realtor is the center. I hate for sale by owner transactions.
Well, so do realtors.
It's nuts. No one's in charge.
Right.
But somebody knew somebody who knew somebody. And the way this should work, the realtor's right in the middle of the transaction, and everything revolves around the realtor. It's perfect the way this little thing works. But without somebody who really knows what they're doing in the middle, being the ringleader, because it is a circus. You do this thing with aplomb, and you glide over the top. But I know what's going on to keep all that stuff together, because it is a circus. So that it looks just seamless, and everybody ends up with a smile on your face at the end. Realtor's the place to start, always. And it doesn't cost the buyer a dime.
Right.
I mean, give me a break. It doesn't cost a dime to have incredible professional representation and guidance. How often does that happen?
Exactly.
So,
Well, and it does cost the seller some, but we end up making them more money than if they went at it alone.
I have seen that 100 times.
Yep. So there you go. All right. Well, Dan, you're awesome. I'm so thankful.
I'm anxious to hear what I had to say.
Well, we'll play it back to you. How about
Okay.
that? Yes, but it was very informative.
Well, I enjoy these get-togethers. I truly do.
Yes. Well, thank you.
All right.
Yes. Well, thank you, Dan, for being on the podcast again. I
All
hope
right.
everybody who's listening got a lot out of this, and I would think that they did, because you always have a
I hope
font of useful information.
Yeah, sometimes it's font of overflowing.
Well-
But,
Well, if anybody has any questions, they can call you.
yeah, absolutely.
So, and I strongly encourage anybody who has questions to call Dan, because Dan has the answers. So, and if he doesn't, he'll look them up.
I'll look them up.
Yeah. So anyway. All right. Well, thank you for listening. And here is to the next one.
All right.
Bye.
Bye-bye.